Now, when you're talking about investing in the equity markets, there are various options available for you. If you're investing directly, you look at stocks that are listed, and if you're investing through mutual funds, there are various funds available. Now, within the equity categorization of equity mutual funds, there are often various choices that you can make. And a seemingly interesting choice that you can make now relates to the business cycles that often affect various companies. So, for example, a cement company can benefit from a business cycle that supports infrastructure growth, or a steel company can benefit from the construction activity that picks up as an economy is booming. We're going to be talking about these funds with Rahul Singh, the CIO of Equities at Tata Mutual Fund. Thank you so much, Mr. Singh, for joining in. You currently have an NFO that is open. Could you tell us a little bit more about this relatively new category of equity mutual funds, though?
Sure, and welcome to all the viewers. I think the opportunity in Business Cycles Fund, when we first looked at this category, is coming from two major points I wanted to make. One is that while bottom-up stock investing has its merits, over the last 5 years, we have seen that there have been some wild swings in the business cycles, whether it's because of events or because of COVID, whatever be the reason. We have seen, business cycles changing course quite dramatically over a period of 18 to 24 months. And when we look at a typical fund today, which all the AMCs have, most of them rely predominantly on what we call as bottom-up stock picking and bottom-up investing. Obviously, we keep in mind the sector tailwinds or headwinds, but a bulk of the investment philosophy or investment conclusions are drawn using bottom-up stock level or company level analysis. What we are trying to do in Business Cycles Fund is to completely turn around this logic and look at sectors first and then stocks. Why do we want to do that? Because as we have seen in the last 5 years, the business cycles and the changes in the way sectors perform in different parts of the business cycle creates a lot of alpha, sometimes more alpha than stock selection. And we think there is an opportunity here over the next 3 to 5 years as well, because we all know, given the level of disruption, the level of information available, and the level of intervention by the central banks and the governments through monetary and fiscal policy, the cycles are becoming shorter, much shorter than what they used to be traditionally 3 to 5 year long. And I think that gives an opportunity for Business Cycle Fund to become more mainstream. Become a core part of anyone's portfolio, because it's completely top-down investing. And while bottom-up investing has its merits, I think there is an opportunity that business cycle investing through the top-down approach, through sector allocation first and then stock selection secondary, becoming more and more important in the years to come. And that's the whole objective of the Business Cycles Fund NFO, and the whole mandate is to really navigate these changes in the business cycles, which are happening more frequently, efficiently through sector allocation rather than only.
Now, Mr. Singh, one of the factors that occurred to me when I was looking at this category is that traditionally, when one has looked at diversifying one's equity portfolio, one has looked at thematic funds. So you look to, say, an IT sector fund or an FMCG fund or a banking fund, anticipating that certain changes will occur in the economy. And therefore, you make allocations within your equity portfolio to these sectors. My understanding would be that the Business Cycle Fund would be a little bit more nimble than that and would not require you to change those allocations on an ongoing basis. Is that the right way to look at it?
Yes, I think you've identified the positioning very correctly. In fact, I would go one step ahead and explain that point a little bit more in detail, because that would benefit the investors. You know, when we look at sector funds, and we have a full suite of sector funds that have done well over long periods of time, but sector funds go through a cycle. Therefore, when investors invest in a particular sector fund, they need to be very aware of why they are buying it and when they should exit. I think the first part is usually clear. The second part, usually investors miss as when to exit and when to move to other sectors. Might be at a sweet spot at that point of time. And therefore, if the investors can do it themselves, if they're knowledgeable, savvy enough, well and good. But we've seen from our experience that most of the investors are not really adept at exiting at the right time. And therefore business cycle fund kind of fills in that gap. It's a bit like balanced advantage funds which manage the equity and debt allocations depending on the valuations. Investors can do it themselves, but we have known that emotional reasons kind of supersede logic, and investors don't end up adding equity at the right point of time when the valuations are low. The same logic goes for business cycle fund, that it is kind of doing that job for you, for the investors, and entering the right sectors and exiting at the right time for you. I think that's the key objective, and that's the key need which this fund would fulfill, in my view. So I think you've identified the positioning quite correctly, and I just thought I explained that a little bit.
Mr. Singh, I do want to understand the composition that you intend to have, just so that my viewers perhaps can fit this in terms of the degree of risk that they would be looking at if they were to invest in your fund. Will you restrict yourself to a certain market capitalization, for example? Because you say that when you look at a business cycle, you will look at a sector and you will identify the leaders, and you will say that you will try and catch that business cycle early and thereby benefit from the growth that the sector will have. But will you restrict yourself to the leaders? Will you also look at small caps?
Yes, obviously, because we don't have particular restrictions on large cap, but at the very minimum, we do intend to have a healthy level of large cap proportion at all points of time, around 10%. But if the cycle demands, and if you are in a slowdown or a recession period, and the cycle demands that we be more into large caps and be in sectors which are defensive, which are dominated by large caps, we will be at 88%. Similarly, if we are at a stage where we are in a recovery phase or an expansion phase, we would obviously like play it through sectors which may have more representation in the mid and small cap segment. So I think everything is linked. And if the sector choice determines that we reduce the large cap proportion from 80% to 60%, so be it. So we would not make that as the starting point, that we should have large cap of X, Y, Z and come what may. But yes, what I can really confirm is that from our experience, depending upon the cycles we have seen, that the large cap proportion would vary between 55-60% in a scenario when economy is doing well and cyclicals are doing well, to 80-85% when when the economy is not doing well and the mid and small caps are struggling, because the sectors where mid and small caps are present are also struggling. It's not about large, mid, small as asset categories. It's more about the sectors where you want to be present. And if those sectors have more presence in large cap will dominate. If sectors have more presence in mid and small caps, the mid and small cap proportion would keep getting up. But we don't expect that mid and small cap proportion would go beyond 40-45%, even in the most, let's say, most of the, even in the most kind of high economic growth kind of a scenario.
I get it. I understand. I do want to also understand from you, I read in the document that this is primarily going to be an India-focused fund. But having said that, and here's just an illustration of that, assuming that electrification of mobility is a theme that will play out over the next 5 years or 7 years or something like that, and you see a huge opportunity in, say, a large global automotive company that is going to ride this business opportunity or this business cycle, would you also consider investing in such a company?
Potentially, yes, but it's not the first preference. I think as far as possible, predominantly it will be in India dedicated investments. And we think India is a very, very diverse market. So we get a whole range of defensives to the whole range of cyclicals. We get a lot of choice. And in times when the Indian economy is not doing well and we are really short of choice in terms of which sectors to pick, we will obviously rely on some overseas investments. At this point of time, it's difficult to say which part of the cycle those investments would kind of be in as far as the overseas investments are concerned. But it's again a function of the cycle. If the Indian economy is going through what it's going through today, which is somewhere between recovery and full-fledged expansion, we really don't see the need to really go out and have significant outside of India. But there might be times when we need to, and we'll evaluate the cycle at that point of time and what opportunities there are at that point of time.
I do want to ask you what I think is a really pertinent question in this context is that on the one hand, you're saying that business cycles are reducing in timeline, so they're much shorter now. Having said that, the kind of run that we've seen in the equity markets since the pandemic started and the recovery obviously has been substantial, we've seen that a lot of these stocks across sectors are at all-time highs. The valuations seem to be pretty rich at this point. Where do you see the most opportunity right now?
Yes, you're right. I think the opportunity or the cyclical kind of upsides which we want to capture needs to be looked at in the context of valuation also. We cannot blindly follow the cycle without and overlook the valuation. Having said that, I think in an NFO, we have the advantage of picking our time when we want to increase weightage in the sectors which we really want to increase, rather than, so we have the option to wait, obviously, and wait for the right price. If that does not happen, we have the option at other sectors or other stocks in the same sector which we like. And therefore, we will be picky on valuations. We will not ignore it for the sake of just that we have to buy a certain sector. We will not ignore valuations. Having said that, to answer your question, I think there are certain pockets of industrials, capital goods. There are pockets of utilities, power utilities, which are going through a cycle of conversion from fossil to renewable of generation. So there are opportunities out there from a valuation perspective also, which we see clearly. And there, at any point of time, we think that the market will always have certain sectors or stocks which are being underappreciated. And if we can pick up the cyclical point at which the earnings start to get re-rated and valuations start to get re-rated, we would have done our job. And just to reiterate that point further, I think most of the times the effort in Business Cycles Fund would also be to identify the sectors which are not necessarily contra, but ahead of time. I mean, at least 6-9 months ahead of before it starts to become a consensus. And I think while yes, you're right that the opportunities have become smaller and the sample set which we would have worked with 1 year back or 6-9 months back, that opportunity set has narrowed down. But as I said, being an NFO, I have the luxury of a little bit of a luxury of time to really pick my price points at which I want to weightage in those.
Mr. Singh, it's been an absolute pleasure. Wish you all the best with the NFO that you have and everything else that you aim to achieve with the fund house.